All right, gang. So welcome to the Wall Street Jack Boys Stock Foundations course. And in this course here, you guys are going to get a foundation of what stocks are. So it's going to be a must that you have basic understanding of stocks before you can actually get into trading options. You must learn about stocks first, and that's what we're going to cover in this course here. So we're going to start with the why. Why should you invest in stocks? Well, I got a couple of different reasons here why I believe that you should be investing in stocks. Now, you don't need for anybody to sell you on the fact. You can just look in the markets. It's all over the news. Stock market hitting new highs. All the money in the world is going through the stock market. So that's exactly where you need to be. All right. But if you're looking to build wealth, which is my topic number one here, building wealth, you need to have stocks, right? Because stocks is the number one asset class to build wealth. So most of the wealth in this country is generated in the stock market. Now, also to build retirement savings. If you're ever thinking about retiring, you need to have money, in a retirement account, whether it's a 401k or IRA, mutual funds. All of this stuff is in the stock market. Okay. Also to generate passive income. So if you want to make some passive income, meaning that cash flow, then, a lot of smart investors that we have, they buy stocks that give them dividend payouts, and dividend payouts is cash flow. So that's how you generate income. Also to beat the inflation demon. Inflation is upon us, you guys. That means that your cost of living is continuously going up. Your rent, your mortgage, everything is just high. Okay. Cost of living is going up, but the value of your money is not. It's actually eating away the value of your dollar. So I think right now inflation is somewhere around 2% as we're shooting this video. So that means if you have any kind of investments, you need to make at least 2% just to break even. Okay. Anything under that, then you're negative because you haven't beat inflation. That's one of the key strategies that smart investors do, is to track inflation. All right. Now, also stock market averages 10% over a long period of time. That means throughout all the ups and downs, over a long period of time, you should average about 10%. So that's through the good and the bad. Even if you hold through, you probably more than likely to earn at least 10% on average. Okay. So that's a really good investment. That's a really good reason. Also, savings account interest rates are only about 0.09% right now. That is very, very, very little. That means when you put your money in a savings account, the banks are using your money, but you're not making any money off of it. You're making 0.09%, for you giving them your money because you're putting your money in their accounts and they're using it and putting it in the stock market to make more money, right? But you're not making any money because of the inflation demon that we were just talking about is around 2%. So that means that you're negative. That means that your money, is losing its value as it sits in a savings account. So you need to work the money in a better way. What better way than the stock market? All right. So stock market return over 30% in the year 2019 alone. In my loan portfolio, I think I made like 33% just by having my money and managing my money in there. So 33% minus the 2% inflation. That means I net about 31%. Okay. It's money I didn't have to work for, money you don't have to, bust a sweat for. Okay. That is a really good reason for you to be in the stock market, okay? And then my last point here is that the tax laws favor investors over 9-to-5ers. We actually wrote an article about this. The tax laws, again, they are what they are. They were written by businessmen for businessmen and investors. So if you're an investor, then you have, better incentives than people that work a job. People that work jobs, they pay more than everybody else. Yeah, I didn't write the laws. That just is what it is. Okay? So let's get into what are stocks. This is what stocks are, okay? Stocks are pieces of ownership, okay, shares of a corporation that are available for investors to buy and sell, okay? Shares, again, pieces of ownership of a company, all right? And they are available for anybody to buy and sell them, okay? And we're going to get more into this so that it actually sticks, but that's what stocks are. They're just pieces of ownership. Now, when you buy a stock, you're buying a small fraction of the company, which makes you a shareholder. And by being a shareholder, you now own a piece of the company's assets and have claim on future earnings of that company. Stocks are also known as equities. Savvy investors use the term equities often, so don't be alarmed when you hear the term. So get familiar with the term equities. You're going to hear it a lot. Don't be alarmed. It just means stocks. Stocks and equities are the same thing, okay? So again, what are stocks? They're pieces of ownership of a corporation, okay? That just means that people can buy rights, of the company. All right. And where do stocks come from? Well, this is where stocks come from. Okay. Stocks are created by corporations in order to raise capital from the public so that they can grow. All right. So when a company is looking to grow, you're a mom and pop shop, you need to get to the next level. You're going to need capital. It means money, capital with money, same thing. But you're going to need a lot of money. Okay. And you can't reach the whole world, right? You're just in your little neighborhood community. But if you can reach the world, then you can raise a lot of money. That's what corporations are doing. They go to the stock market to raise a lot of money so that they can get to the next level. Okay, you ever see people that's on like Shark Tank? They go in there so they can try to get some money to try to grow the business. That'd be like the first phase in the private market. And then those guys like the sharks and all those guys, if they blow the company up, they're going to actually, launch the thing and go to the public market so that everybody can get a piece of the action. So that's pretty much how it works. Now, companies have two ways to raise money. They can either take on some debt or they can issue equity, all right, which is stocks, issue bonds or issue stocks. Debt is bonds, equity is stocks, okay? Now, companies choose to raise capital through issuing stock so that they don't have to go into debt to raise large amounts of money. All they do is just give away shares of ownership, okay? So they don't want to go into debt, well, they issue stock. Some of them, they'll take on the debt. It just depends, right? But some cases are better than others. But that's the reason why you get stocks, because companies are looking to raise some money. Now, this is a good little scenario here because everybody know what a GoFundMe account is. You've seen them all over Facebook. Any and everybody can make a GoFundMe account. So why not get paid to give away money, right? This guy here, in this case, this guy here made a GoFundMe account to build a wall. Whether you like it or not, I don't really care. The point is that the guy raised $19 million over GoFundMe just by having this account open to the public. And everybody can just give away money to it. And obviously, he's raised a lot of money. It's what, 333,000 people in 24 days. This guy raised $19 million for whatever it is that he wants. He wants to build a wall, help Trump build a wall, whatever he wants to do. It doesn't matter. You can make one. Right now, we have one of my friends who's diagnosed with a rare form of cancer as a GoFundMe account, and we're all contributing to it. So, the thing is that the stock market works like the same way. With corporations, they work the same way, right? So in this case, you want to help this guy build his vision, so you just donate money. But in the stock market, these are corporations. They're also looking to raise money for their endeavors, whether they're trying to make new phones, new technology, or whatever. They need to grow. They need capital, and you can help them to achieve that goal. But the difference is with stocks, when you give these corporations your money, you actually get something back, okay? So you actually get dividend payouts, cash flow payouts, right? You also get the appreciation of the stocks when it goes up. So what's the better case? Give away money for free, you get nothing in return. That means you have a 100% loss, or you give your money to a corporation to help them to fulfill their dreams, and then you're going to make yourself some money. So anyway, this is a good scenario for you guys to see it, but that's basically what it is. Everybody's looking to get some money. And so he's in the general public. Corporations are going to the general public also, except they're going to the stock market, and that's where the general public can access these things. All right. And let me go back. Shareholder benefits. Shareholders normally buy common shares, which gives them the right to vote in the election of the company's executive team, approve or vote against new shares, issues, and other money-raising activities. And the more shares, the more votes, which means more influence. So this is one of the benefits of being a shareholder, okay? Once you buy stock, okay, they used to give paper certificates. Now everything is in digital tokens, okay? So you don't have a piece of paper. You get like a digital token that's in, the brokerage account. So you can see it there. You can see your ownership there. With that ownership, you have rights, okay? So because you now have rights, what are those rights? So some of those rights are basically voting rights, okay? So when a company is looking to, hire, new talent, when they're looking to approve certain things as far as raising money, you have a right, you have a say-so. Okay. And it depends on how many shares that you have in that company. That's going to be the bigger influence you have. So every share is a vote. Okay. So you got one vote, and then the other guy got 1,000 votes. Who has the most influence? The guy with 1,000 shares, right? Because he got 1,000 votes. So he has a higher influence. All right. Now, common shares, as you guys can see, common shares is what we're actually trading in the market. So that's what you're going to see all day, every day in the markets is the common share. So there's another form of shares called preferred shares, which I have highlighted to the side. And this just means that preferred shareholders, they receive dividends before common shareholders. They have higher claim on the company's assets than common shareholders do. And if the company were to shut down, then basically they get paid out first. All right. And then they normally don't have voting rights, and they have no ownership claim on the company. So I just want to actually go over that one because you guys hear the term about preferred shares. It's not common that you will hear about it. Again, these guys basically in the highest order of priority when a company is formed. And if a company fails, first people that get paid is the debt holders. That's the bonds. And then after the bondholders, then you get the preferred shareholders. Okay, so these guys, they normally don't get the payouts and the other benefits like voting, but they get priority in case the company fails. They're going to get their money first. And then if there's anything left over, then the common shareholders, they get their payout. So those are the perks of that. But what you normally see in the market is going to be common shares. Okay, so when we talk about shares, we're talking about common shares. Now, some companies reward its shareholders with regular cash flow from its profits, also known as dividends. The more shares you own, the bigger payouts. And this is a great source of income for investors. We just talked about that earlier as far as the cash flow. This is another benefit of being a shareholder, because when the company makes that money, when they get some free cash flow, they had to actually, do something with that money. And what are they doing with that money? Well, in this case, they're going to pay dividends to the people that looked out for them when they needed the money. So you're going to get paid out, right? Versus a GoFundMe, you get nothing after the guy get his wall built or whatever he's doing. You don't get nothing in return. But here you do. And then number 3, appreciation of the stocks is another benefit. If you own shares of a company that is performing great, then the value of those shares increase, allowing you to sell for profit. So not only are you getting all these other benefits, but as the stocks go up, you're actually appreciating, your shares are appreciating. So therefore, you're able to sell at a higher price sometime in the future. So those are benefits of being a shareholder. Now, what are the risks of being a shareholder? A company's stock value can plummet to zero. And if the company fails, then you can lose all the money that you've invested in it. So the risk means that, okay, what's the possible risk? Worst case scenario, you can lose all your money. All right. If a company fails, as I just mentioned, common shareholders are on the bottom of the totem pole. So after everybody's paid off from a company failing, if there's anything left over, then you could get paid out. But more than likely, you probably lose everything. So that's just a risk that is a reality. We don't see it happen often, but it can happen. And IPOs, initial public offerings, you're going to hear about this in the markets, and this is important to understand. So what is an IPO? So when a private company wants to go public, it has to go through an IPO. The IPO is the first time that a company sells new shares to investors in a public market. So this is the first time they launch. This is their debut in the markets, okay? Now, why do companies go public? We just talked about this earlier. Now, it makes it easier to raise capital so that they can grow. That's why. Also, it raises brand awareness, okay? Because once they're in the public markets, everybody and their mama is going to know about them. And then also, if they want to attract talented staff or management, then, if you're listed on the public stock market exchange, then, you have some clout there. So, again, gain credibility, that's that clout. Provide liquidity to shareholders, that's another thing. So, again, in the beginning stages, in the primary markets, there's not many people that's there. It's kind of like private. And so when you have those investors that are actually looking to liquidate, they're looking to sell their shares to make some money, they don't have the luxury of being able to get in and out, okay? But in the public markets, you got access to the whole world. It's like so many people. It's so liquid. So that's what they do to provide liquidity to shareholders. You want to go public, okay? Now, the disadvantage of going public is increased regulations and the cost behind those. So once you go public now, the problem that you got to deal with is that the SEC is on you now. And then you got to do all these filings. You got to be transparent with the company's operations and things like that. And that costs money. So that's a disadvantage of going public. OK. All right. Now, where can you access these stocks? So the stock market is the public market for companies to issue stocks for institutions, investors, and traders to buy and sell stocks on a stock exchange or over the counter, which is OTC. Stock exchanges like NASDAQ and NYSE, which is the New York Stock Exchange, there are electronic exchanges that facilitate the transactions between buyers and sellers of stocks. And brokerages like TD Ameritrade allow retail traders and investors to buy and sell stocks on their Thinkorswim platform. So how are we going to access these stocks? We're going to go through our trading platform. Thinkorswim is what we're actually using. And that's going to actually give us access to this market where all these companies are trying to get rid of their shares so they can raise some capital. And stock investing styles. So there are lots of different stock investing styles. The two most popular ones will be growth stock investing and value stock investing. I want to cover these things here because you guys are going to hear about this as you embark on this journey of trading and investing. So what are growth stocks? So growth stocks are companies that have shown growth and substantial or rapid increases in business and profit. Young companies normally, okay, and they normally pay no dividends. So these companies here, they're trying to grow. And when they generate some cash flow, they're probably not going to pay out dividends to their shareholders. they're probably going to take that money and reinvest it into the company and research and development so they can keep getting bigger and better and keep on growing. So we call these growth stocks, okay? And so there are investors that actually, like to buy growth stocks. That's a strategy there. Now, the second form is called value stock investing. Value stock investing, you guys know Warren Buffett, I'm sure you have. This is his style of investing that you will hear mostly in the markets is value stock investing. So what are value stocks, though? So value stocks are great companies that have been profitable for a long time. They have been mispriced by the markets and through analysis have been identified as at a discount to its real value. Real value means intrinsic value, okay? And these companies normally pay dividends, all right? So these companies here, great companies, and maybe have been mispriced by some kind of mishap, that's not representing their real value, okay? So if you can identify that, you could buy that, and then once it gets properly priced, then you're going to make some money, all right? So growth stock and value stocks. Now, the key to trading and investing, just to break it down to the simplest form, is to buy the lows and sell the highs. That's all it is. And anything in business, anything, in business related, period, you just want to actually get in at the lowest point and then rise to the top. Okay. And so you guys look at this chart, we have points in the market where you see that it goes high and it goes low. And so as investors, that's what you're trying to identify, when to get in and when to get out. So you have to identify these mountain peaks and valley lows. And so that's the key to investing. You find a valley low, you get in. You see it reaches at its peak, you get out. And you rinse and repeat. That's the key to trading and investing. Now, investors, they normally go over a long period of time. Traders are usually doing this on smaller time frames. All right. So what kind of stocks do we have to trade? Okay. So the two popular stocks that you guys will be hearing about and seeing are blue chip stocks and penny stocks. Okay. So what's the difference between blue chip stocks and penny stocks? Blue chip stocks, these are stocks of well-established corporations with a reputation for reliability, quality, and stability. They are the most popular stocks to buy due to their long track record of steady earnings or paying dividends. Smart investors prefer blue chip stocks. Just like blue chips and poker carry higher values, blue chip stocks may not necessarily be highly priced, but they are of the highest quality. Okay. So blue chip stocks, these are the companies that you guys are familiar with, you use on a daily basis, whether it's your Amazon, whether it's your Facebook, your Apple, whether it's Coca-Cola, your Kroger, all these companies, these are blue chip stocks. Okay. They've been around for a long time, more than likely, and they're probably going to be around for a long time. You can you can predict these a little better as they have their normal business cycles and things like that. So just think about those as great quality stocks. And then the other form you have is penny stocks. And penny stocks are very popular. You have a lot of penny stock traders out there. What are penny stocks? Now, these penny stocks, they are common shares of small companies that is traded at a price less than $5. Okay. So if it's under $5, then we call it a penny stock. It's not a penny, but if it's under $5, I mean, you do have some that may be a penny. But again, these are small companies that's trying to get into the public market. They're trying to get access to this capital here. Trying to prove themselves, by being in the market here. Now, you may hear about these also known as pumps and dumps, because that's what happens often with these companies, and we'll go over that a little bit later. But basically, these shares of these penny stock companies are usually traded over the counter, such as an OTC bulletin board or OTC Link LLC, but can also be traded on the stock exchanges, including foreign stock exchanges. The shares are extremely illiquid and very volatile. The lack of public information and limited historical information is another reason what makes these companies very volatile, because we don't really know anything about them. They don't have a track history. We can't really predict. We don't really know what's going to happen with these. Now, in this course, understand that what we're actually going to be doing is going to be dealing with blue chip stocks. Okay. So again, they have higher predictability factors versus penny stocks. These are wild cards. These are kind of crazy. Doesn't mean you can't make money there. It's just not the strategy that we're teaching in this course. All right. And stock analysis. Okay. So these are two different types of stock analysis that you must be familiar with. These are the classicals here. You have your technical analysis, and then you have your fundamental analysis. So with technical analysis, this is where you're looking at the historical price of a stock in the form of a chart or a graph and deducing the probable future trend from what you see. So technical analysis is basically, scanning the charts, analyzing the charts, and deriving conclusions, okay, making forecasts and making your investment decisions based off of charts, graphics. You can see those. That's easy to see. Any mama can see patterns and things like that on charts. And that's what we actually teach here at Wall Street Jack Boys, the technical analysis and analysis, I guess. So technicals. Fundamental analysis is the other one here. So we have fundamental analysis, where you're basically looking at financial statements and reports to arrive at an estimate of future business conditions and valuations. So this is not so sexy, but you're basically looking at, the filings for these, corporations, these companies through the SEC, and you're dialing through their financials and their valuations, and you're making your investment decisions based off of that. Now, I don't think we have too many pure fundamental analysts these days. A lot of them use a mixture of both, okay? So you do get stronger predictability factors if you could combine, both of these here. But it doesn't mean that you have to use them. The most popular one is technical analysis, and that's what we're going to be teaching here. So, all right. So how to find stocks you trade. Now, there are thousands of stocks available for trading, and we use a scanner to filter out stocks that we're not interested in trading. Thank God that the trading platform does this task for us, making this experience stress-free. So, again, there's thousands and thousands and thousands of stocks that's out there. I mean, it's like, which way do you go? So we use the computer system, our trading platform, Thinkorswim. It's going to filter that out for us. It's going to let us know, it's going to filter all the garbage. It's going to let us know the ones that we need to be focused on. And here, the stock market is an auction, okay? Understand that the stock market is an auction. So if you've ever been to an auction, you have the auctioneer who's actually selling products for whoever the sellers are. So the sellers, they present it to the auctioneer. He's going to actually deliver it to the market, or he or she. And then the bidders, the buyers that are looking to buy these things, they're lined up and they're bidding. Okay. They say, hey, I want it at this price. I want it at this price. And then they bid the prices up until it reaches peak. And then, the person, they win the auction, and then they go to the next product, basically. So that's basically what you have in the stock market. If you think about it as an auction, it really simplifies this whole thing here. So you got here to join the bid, you got join the ask. These are things that you'll see like in the platform itself. So I just put those in there. But basically, buyers bid and sellers ask. These are two concepts that get yourself familiar with. Is that buyers bid and sellers ask. Sellers are asking for a price for their product. Buyers are bidding because they want to get a piece of the action, right? So when an investor buys a stock, he is said to be long the stock. He is optimistic that it will go up. The term long means that you're optimistic. You are bullish. That's another term, bullish. Bullish, long, buy. Same thing. Now, when an investor sells a stock, he is said to be short the stock. He is pessimistic and believe that the stock will go down. So, yes, you can also make money if the stocks go down as well. Those people are selling. They're shorting the stock. Okay. Now, this is if you're entering at a short position. So you can enter, that means you can get in at a short or you can get in at a long. All right. But if you're getting in and then you're exiting, meaning you're selling, that's different. That means that you're just buying low, selling high. But these are basically, you see join the bid, join the ask. Join means that I'm entering into that position as a buyer or as a seller. All right. So the function of the markets is where corporations sell shares of ownership of the companies to raise capital, and where investors and traders buy and sell those shares for profits. That's basically what it is. Okay. So everything that we just went over in this course is pretty much everything that you need. Now, it's value packed and short form content, but this is everything you need to know to understand the stock market. All right. And so what we'll do next is that I'll actually take you guys through the platform and show you how to buy and sell stocks.